This content is for educational purposes only and is not financial advice. Consult a qualified advisor before investing. Hello and welcome back to Understanding Money. In today's in-depth masterclass, we're exploring two of the most fundamental building blocks of any investment portfolio, stocks and bonds, and helping you decide which mix is right for your financial goals, risk tolerance, and time horizon. If you're ready to make smarter investment choices, tap like, drop a comment with your current allocation, and subscribe to never miss a lesson. Let's start with a simple question. What exactly is a stock? When you buy shares of a company, you're purchasing a small piece of that business, an ownership stake. Stocks represent equity, so as the company grows and earns profits, shareholders share in those gains through rising stock prices and, in some cases, dividends. Ownership also carries certain rights, voting on board members, approving major corporate actions, and accessing annual reports. Now contrast that with bonds. A bond is essentially an IOU issued by a government or corporation. When you purchase a bond, you're lending money to the issuer in exchange for periodic interest payments, known as coupon payments, and the promise to return your principal at maturity. Bonds don't confer ownership. They sit higher in the capital structure, so in the event of bankruptcy, bondholders are paid before equity holders. This priority makes bonds generally less risky than stocks, but it also means they offer lower potential returns. Next, let's unpack key characteristics side by side. Potential return stocks have historically delivered higher long-term returns, roughly 7 to 10% per year on average, thanks to company growth and reinvested dividends. Bonds typically yield lower returns, around 2 to 5%, reflecting their lower risk profile and fixed income structure. Risk and volatility: stocks can be volatile. Prices swing with economic cycles, earnings reports, and market sentiment. While that volatility can amplify gains, it also means larger drawdowns in downturns. Bonds tend to be more stable. Prices fluctuate with interest rate changes, credit quality concerns, and inflation expectations, but their income payments provide a buffer against market swings. Income versus growth: stocks offer growth through capital appreciation, and for dividend-paying companies, income that may grow over time. Bonds provide predictable income streams via coupon payments, making them attractive for income-focused investors, retirees, or as ballast against stock volatility. Duration and sensitivity. Bond prices react to changes in interest rates. When rates rise, bond prices fall, and vice versa. Longer duration bonds, those with later maturities, are more sensitive to rate changes. Stocks aren't tied to a fixed rate, but can respond sharply to shifts in monetary policy, inflation surprises, and economic outlooks. Diversification benefits. Combining stocks and bonds can smooth overall portfolio returns because they often move differently in various market environments. For example, bonds may hold up better during equity bear markets. To bring these concepts to life, let's examine three illustrative portfolios over the past 2 decades. Portfolio A: 100% stocks from 2003 to 2023, a pure equity portfolio, returned an annualized 8.5%. However, it experienced drawdowns as deep as 50% during the 2008 financial crisis. Portfolio B: 60% stocks, 40% bonds. The classic balanced portfolio returned about 6.5% per year, with maximum drawdowns around 30%. The bond allocation cushioned losses during equity downturns. Portfolio C: 30% stocks, 70% bonds. A conservative mix returned 5% annually, with drawdowns under 20%. Income from bonds provided stability, but overall growth lagged higher equity allocations. These examples demonstrate the trade-off between growth potential and volatility. If you're a young investor with decades ahead, a higher equity mix can harness growth. If you're nearing retirement, a heavier bond allocation can preserve capital and generate reliable income. Now, how do you decide your ideal stock-to-bond ratio? Let's work through a simple 4-step framework. Step 1. Define your time. Longer horizons, 10+ years, can generally tolerate more equities because short-term volatility smooths out over decades. Shorter horizons, under 5 years, benefit from greater bond exposure to protect principal. Step 2. Assess your risk tolerance. Are you comfortable seeing your portfolio drop 20% in a market sell-off without panicking? If not, increase bonds or consider alternative assets. You can gauge your tolerance by reviewing past market downturns and how much loss you could stomach before selling. Step 3. Establish income needs. Do you need regular cash flow? If so, bonds, dividend-paying stocks, or even bond ladders can provide consistent income. If you don't need income, focus more on growth-oriented assets and reinvest dividends and interest. Step 4. Factor in other assets and liabilities. Your home equity, private business interests, or real estate holdings also affect overall risk. If you already own property, you might tilt more toward equities. Consider liabilities like mortgages or student loans. High-interest debt can be a drag. It may make sense to pay down debt before allocating heavily to bonds. Once you've determined your target allocation, maintaining it through regular rebalancing is crucial. Market moves will skew your mix over time. For instance, strong equity performance can push your portfolio to 70% stocks even if you target 60%. Schedule quarterly or annual rebalancing to sell high and buy low, restoring your desired risk profile. Let's pause for a moment to address a common question. What about bond maturities and credit quality? Bonds come in various flavors: short-term, intermediate, and long-term maturities, as well as government, investment-grade corporate, and high-yield junk bonds. Short-term government bonds offer safety, but very low yields. High-yield bonds pay more, but carry greater default risk. You can create a laddered bond portfolio, buying bonds that mature in staggered intervals to manage interest rate risk and ensure liquidity for income or rebalancing needs. Another popular tool is bond funds and ETFs. Instead of buying individual issues, you gain instant diversification by holding a basket of bonds. Just pay attention to the fund's average duration and yield, and choose funds with low expense ratios. Now, let's talk about stocks. Not all equities are created equal. Within your stock allocation, you can diversify by market capitalization, large cap, mid cap, small cap stocks, each with different risk-return profiles. Style. Growth-oriented stocks reinvest earnings into expansion. Value stocks trade at lower price-to-earnings ratios and may pay higher dividends. Sector exposure. Technology, healthcare, consumer staples, financials, and so on. Sector diversification helps shelter your portfolio during sector-specific downturns. For many investors, low-cost index funds or ETFs offer a straightforward path to diversified stock exposure. Total market funds cover thousands of companies in one trade, eliminating single stock risk and avoiding the need for individual stock selection. Before we wrap up, let's revisit how stocks and bonds behave during key market events. 2002. Tech bust. Stocks plunged more than 45%, while bonds provided positive returns as interest rates fell. 2008 financial crisis. Equities dropped over 50%, but high-quality bonds delivered double-digit returns. 2020. Pandemic crash. Rapid equity sell-off followed by unprecedented monetary easing. Both stocks and bonds rallied together. These historical patterns reinforce why blending stocks and bonds can smooth out portfolio swings and enhance long-term returns. As a final note, remember to keep costs low. Expense ratios, trading commissions, and bid-ask spreads chip away at returns over time. Opt for commission-free brokers and funds with expense ratios below 0.1%. Use tax-advantaged accounts to shelter income and capital gains where possible. And a quick compliance reminder: I'm not a licensed financial advisor. This content is for educational purposes only. Always consult with a qualified professional before making changes to your investment strategy. To summarize, choosing the right mix of stocks and bonds depends on your time horizon, risk tolerance, income needs, and existing financial situation. Use the framework we discussed, maintain your allocation through rebalancing, and stay disciplined during market ups and downs. If you found this guide helpful, please tap the like button, share your target stock-to-bond ratio in the comments, and subscribe to Understanding Money for more in-depth tutorials. Thanks for watching, and I'll see you in the next video.